Now, Samir Arora is joining us, founder and fund manager at Helios Capital. Samir, great to have you with us here. It's a pleasure. Thanks very much. You know, interesting tidbit. I just wanted to sort of tell you this and do have, I don't know if you have any thoughts. Someone I was chatting with was not complaining about the bull market. He said, but progressively as the market continues to go higher, he said, my portfolio is not keeping track with the gains that you're seeing on the index. Because, I mean, you know, participation widens, right? Everyone makes money, but participation widens and all kinds of stocks go up, which it would be out of one's radar. I mean, you can't hop into one stock, new stock, and all of that stuff.
That is why you're supposed to focus on the stocks that you have on your screen. Because otherwise, if every day you look at any one stock and say, oh my God, this stock is up or that stock is up. But broadly, if you look at the US, it looks more hyper than India. I mean, India, I think, is still disciplined in the sense that half year is over and the market, that is Nifty, is up like 10%. So that is not so out of line with any normal strong year, and therefore I feel much more bullish that way on India right now than I am in US, where also, as you know,
But things, Samir, just one point on that US bit, things have turned dramatically last 4-5 days, actually last 6-7 days in the US as well. Dollar is crashed and the yields have come off very sharply, and the famous Goldilocks, potential Goldilocks is back.
But these tech stocks have done really well, these 6-7 stocks. But my feeling there is that the interest rates will still be hiked. At least one will be hiked now, and the language will not be changed, because whatever we say, their target is 2%. Now they have to otherwise change the target. So if so let us say the returns are capped at, the interest rate is from here is not hiked. But for it to be cut, it looks too wild. And so therefore, if that is not cut for a year and the mortgage rates are 7.25%, I think tech in US is better than the overall market in US, because the rest of it is much more economically sensitive. Although it's the tech stocks which go up and down a lot because of discounting maybe, rather than because of the impact on their earnings. So overall, I can't imagine that the interest rates will be cut because one inflation, or will be even paused right now because one inflation number came out better. But who knows? Let's focus on India, which is easier to imagine.
It is. And what a story, right, Samir? Before I ask you about all of that, we were just debating whether we should make those 20,000 T-shirts and wear them, since the Nifty is hitting 20,000.
So I heard that you can recycle those, but as long as the sensex word is removed, and you can put some new thing on it. But broadly, it is right that you should not oversell any of these, because at these points, the people get very excited, and some people may look at it that what a big milestone, and therefore it's overdone. And according to me, in even a slightly longer term, it is not at all overdone, simply by looking at 2-year numbers or looking at them in dollars. And therefore, it's not a high which has come very quickly over its previous high. It's taken 2 years. So broadly, if you look at annualized returns from the market last year, this year, they are well below normal. I mean, not this year alone, but if you combine it with last year.
No, absolutely. I mean, we were doing that study on how the valuations are stacked up as well, right? I mean, the Nifty is still between the 18-19 times range, and it's just slightly higher than the 10-year average. So valuations of India are not that expensive compared to its own average. In that context, what are the spaces to look at? I heard you briefly mention tech, and it's come back in a big way in the last couple of months. Is that the space to latch on to now?
So right now, we did not have it going in, and we still don't have it. And right now, we don't feel like changing, only because the rally has been broad. So if you look at even this month, the market is up 3%, and the Nifty IT is up some 5%. And these, other than TCS and Infosys, which are up 7-8%, rest are up less than the market in some mostly. So therefore, you're not feeling left out because of the fact that it is broad. If the market had been narrow, and then we would have had to bang our heads whether we should do it or not. But right now, my feeling is that the guidance and the numbers for this year are not exciting. It is true that the IT sector has rallied this month, but the rest of the world, rest of the market is also doing well. So why bother about changing? In fact, State Bank of India is up much less than Infi, or not Infi maybe, but TCS is up. and it just looks an easier story. So for us, we have not made that change because the rest of the market is also doing well, and some of our stocks are also doing well. But over time, yeah, plus minus 3-6 months, we may think about it. Right now, this idea that the client is saying that currently I don't have business for you, but in 9 months you'll have a lot of business from me, and therefore I'm giving you orders. It looks that those orders are more to do with a different this thing, which is maybe cost takeout and from a different budget or basket, and those are mostly more cost conscious and lower margin businesses, and therefore right now, because we don't have it, we don't feel like doing it because the rest of the market is anyway also doing well. So my bet in the last few months was that as long as IT doesn't pain me, I can live without it, and that currently it's not paining me, although it's going up quite well on its own.
All right. Hi, Samir. Good morning. I don't know about the 20,000 T-shirts, but I'm looking forward to the sensex hitting 1 lakh. Hopefully, I'm here as well. And that 1 lakh on the T-shirt will look fantastic. But Samir, what have you bought recently? The last time you joined us, you told us about Tesla, Nvidia as well. A couple of those stocks.
Forget about the US. By the way, US, I bought UBS recently. But forget about that.
Let's keep that aside. So we know you have bought UBS, so let's keep that aside. Let's talk about India. Yeah.
Correct. So in India, basically in financials and consumer, we added, as I said, because we did not have or do not have IT, that money got reallocated to these sectors, and it's broadly there that we have done. One stock that I bought maybe 2-3 months ago was HPCL, which I told on your sister channel, the Hindi one, Awaz. But basically, I don't have any preset this thing. If there is clear value, I can buy value. If there is growth, I can buy growth. If it is loss making, also I can justify if I have to. But broadly speaking, there have been not very many new stocks because our net is high, our gross is high. Our net is like nearly 75%, which on average has been 62% for 18 years. So there was not so much capacity to buy. In fact, if I one day have to buy ITL, I'll have to bang my head to say what to sell to fund it. Therefore, I'm just going along and saying I'm doing okay. Doesn't matter if IT is doing well on its own or not. But it looks to me that it is overdone there, at least on a relative basis, relative to market.
Yeah, no, absolutely. So, I mean, last time we were talking about all these FT headlines, right, about China. There are equally that many articles about India. That note which Capital International wrote, that essay, that has gone viral. Bernstein wrote a note. There was, of course, Morgan has been writing. There were so many others who've kind of said, with titles like, will this be India's decade? What do you make of it?
I've been saying it for 25 years. But then at the end of that, I have realized that there is no need to oversell anything to get people to invest in equities in India, because India has been doing well in the last 25 years also. In fact, for the last 25 years, India is right at the top, as in number one, and also for 20 years. And for 5, 10, and 15 years, we are number 2 after US. Point being, we don't want to make it a story that so far it was so bad, this market, but now it will turn because it is India's decade. The story is that India as a market has been generally doing well. And maybe all these new things in terms of policies or digitalization or, slightly better current account deficit and maybe slightly better currency, etc., will just make you more confident that the same kind of returns can be had in the future. Because our biggest dream would be to get the returns that the market gave in the last 25 years, because they were world number 1 in returns.
Did you, by the way, see that 2075 estimate?
Yeah, but since I invest with a 1 to 3 year horizon and multiples of 1 to 3 years, many multiples will be required to reach 75.
50
and that is basically Excel.
Nigel was saying whether he'll be there when the sensex hits 1 lakh. Who's going to be there when 2075? God knows.
Normally I justify it and saying my kids are going to have a great time. They'll also be quite old.
probably well past their prime at that time. Okay, but I wanted to talk to you about one space that we're going to have a very lengthy discussion on in some time, which is EVs, and I know that's where a lot of your focus lies as well. Just want to give you one number, right? In India, so far in the first half of 2023, the EV sales were almost 700,000 units, and this is 70% of what you did in the full year in the previous year. So it's, we've already reached that level, which is much higher than what we've done in the preceding years, particularly for India. But I want to understand from you on these stocks, right, that have gained quite a bit, this electric vehicle space. Do you think it's just the start of a multi-year upcycle, whether it's Tata Motors, M&M, Maruti and the likes, even in the broader markets?
No, I think it's absolutely overdone. There is absolutely no logic for saying that EV car sales will be more, therefore you have to buy any of all of these, simply because the overall car sales are being substituting. So the same guys were selling car A, which was the IC engine, and now they'll be selling car B. So let's look at Tata Motors. If it is going to spend $15 billion over 5 years on capex, do you think that there'll be a return earned on that capex with EV? I think absolutely zero chance. These investments are being made to remain in business. These investments are required because the environment or the government or the public has asked these companies to change their technology and make new cars. The public or the environment is not saying that therefore we'll buy more cars or that therefore you will be allowed to make a higher margin, but just to remain in business, instead of making car A, make car B and spend billions of dollars in that transition. It is a massive value destroyer.
Okay.
Value destroyer.
I don't think...
Not climate destroyer, not whatever else the external environment may need. But from an economics point of view, it is simply destroying money, capital, because you are making cars and now you're asked to make a new set of cars and spend all this money, and this money will not be recovered. There is no way. It is just to stay in the game.
Okay, you know what? In fact, Samir, if you have about a couple of minutes more, we have two gentlemen from this space that are joining in. So I want you to just listen into what they're saying and perhaps comment, question them, because, they have, of course, a completely different point of view. They're stakeholders in this business, right?